What we can expect from the market today. Let's take you straight to the stage of Melbourne. Chris Weston from IG. Chris, just hearing from Tom Petrosky there about these Capex numbers. Market very much waiting on these. The RBA, from what we understand, very much waiting on these.
Yeah, I think UBS, I saw a note the other day saying that they actually see this as the most important metric that the RBA can be looking at this whole financial year. So I think there's going to be, there is going to be a lot of people, certainly from a currency perspective, going to be looking at these. In fact, if they do come out weak, we could actually see, the Stevens put being put firmly in the market that, that it reinforces the chance of rate cuts, and therefore the yield plays get a bit of a boost. At the same time, if there's strong numbers, that's great for the economy. It shows that businesses are happy to put money back into the market. It shows confidence as well. So you could see a situation where you've got, a Goldilocks scenario either way. But I think what's really important here is we actually get a future read here for the next financial year. July 1st to June 30th of 2014. It's the business intentions of that year. So it's the first read that we get from this survey. And of course, they survey thousands of businesses here. And it's just the amount of money that they're expected to spend on capital intentions and bits and pieces. The markets, in terms of the future one, is looking for about 175 billion. So, sorry, that's for this year. Sorry, they're looking for a bit less than that. I think it's about 147 billion. So if it comes out lower than that number for next financial year, then you are likely to see the Australian dollar come off quite sharply, because the intentions there that perhaps the RBA are going to come out and cut rates, or give them more scope to cut rates, because the businesses are not prepared to spend anywhere near as much as what the market had been pricing in. The number for this financial year, of course, we get that number as well, is 175 billion, which is, I think, up about 1% or so. So I think that's the number, but it's about the intentions for next financial year that we get this clarity for the first time, and that's going to be huge. It comes at a time when we're seeing a big crossover at a time when the mining investment is expected to peak and actually fall back quite sharply as well. That's the RBA have said that a number of times now. So it's the clarity and that we're potentially going to get from both the mining sector, the most important one here, but also from the non-mining sector as well. If we're going to get this transition from the pullback in the mining sector to the service sector to the non-mining sector, we want to see we get clarity today for that for the first time. So this is why this number is so important. So I think in terms of next financial year, that 147 billion or so number is going to be very important. A much lower number than that, then the Aussie dollar will come off, because the market's pricing in, say, 45 to 48 basis points over the next 12 months of cuts. So 2 rate cuts there. So yeah, it's going to be an important number, and the Aussie and rates could see some big volatility after that number.
I think it's the detail. I think it's the part that you made mention in regards to what the Capex numbers show for mining. That's going to be crucial. If we get a good result for mining, look, that's good, but if it comes at the expense of Capex in the non-mining, that's going to be a big concern, isn't it? Because it shows that the RBA isn't getting its wish of the non-mining picking up the expected slowdown in the miners. And on the flip side, if we get weak mining, again, it might throw a bit of a shudder through the market, showing, well, maybe this mining investment boom's coming to an end quicker than had been expected.
You've hit the nail on the head. I mean, that's the situation. We know that the mining, that the peak in the mining investment has come off, and it's about what's going to happen as a percentage of GDP. We know that's coming off sharply. So, I mean, a good situation for the market today would be a situation where we see a smooth transition, where perhaps the fall in mining investment isn't as bad as what we thought, and we're seeing the non-mining sector pick up the slack as well. We're not seeing huge evidence of that. I think Glenn Stevens has made reference to that as well. So yeah, it's going to be interesting to see. But the first and most important thing, as you point out there, is the business intention for the mining sector, and that's probably going to be the thing that the economists are going to be jumping at straight away.
Wanted to get your thoughts on some of the equity market action we've seen earlier this morning and overnight. Starting in Europe, was it the Italian bond auction, the successful Italian bond auction? I mean, we talked about this on Market Day yesterday with John Noonan. The expectation was that it would be successful, but future ones, depending on this election, may not be quite as successful.
Well, the bond market seems quite assured at the moment. That was, seen in the bid-to-cover ratios last night. Of course, they paid high yields. We're expecting that. The underlying market was trading significantly higher from the previous bond auction. But, let's look at the 10-year, for example. The previous auction, 1.3 times bid-to-cover. This was at 1.6. So that was considered a pretty decent bond auction. The 5-year was again, 1.6 as well. So that was up significantly higher in terms of bid-to-cover from the last one. We actually saw 10-year yields down 8 basis points last night. Spanish yields down 12 basis points. The Italian political situation actually got slightly worse last night. Beppe Grillo, in my best Italian accent there, came out and suggested that he's got absolutely no interest in teaming up with Bersani and the PD party. So, anyone looking for a grand coalition between those two members are not going to see it. Perhaps you could see one between Bersani and Berlusconi. Beppe Grillo talked about that last night on the BBC. Saying that they could potentially do it, but he's not. Beppe Grillo's got no intention of teaming up with Bersani for some sort of grand coalition. So we're still yet to see. I mean, the chances of getting some sort of coalition or unity government before when Parliament reconvene on March the 15th is, it's pretty low at the moment. But no one really cared if that was the situation. And when we saw buying in the bond market, that was the green light for traders to come in and say, look, if the bond market's calm, that's good for us. I mean, you can mix in comments the night before from Bernanke, who's kept the market who's lowered the expectations of an exit strategy anytime soon. That's obviously keeping.
Is it Draghi as well, Chris? The fact that you've got the ECB, as a backstop when it comes to these nations and potentially bond yields getting a little bit unsustainable?
Well, Draghi, will do whatever it takes. But I think, unfortunately, the chances of an OMT program of being announced or being tapped is very low, just because of the dynamics that we're seeing in Spain. If you look at their deficit targets, they're just well out of whack with what they're supposed to be achieving. So even if they came out and requested it now or anytime soon, the first time the ECB actually come and do a review on their deficit situation, they're actually going to fail it straight away. You've got a situation in Italy, if we do see a unity government being cobbled together, you've got such differential stances between the different people. Berlusconi anti-Europe, anti-OMT. You've got Beppe Grillo, of course, he was the protest vote. The chances of some sort of unity government actually requesting the OMT in Italy, not that they need it or have needed it, is very low as well. So his OMT backstop effectively is never really going to materialise. Of course, yields. If you look at Italian yields since it was announced back in July that they were going to do whatever it takes, Italian yields fell 250 basis points on the back of that. So, look, I think Draghi has done very well. He was everyone's man of the year last year, and will continue to do that. That's obviously helped the situation there as well. I actually think what we've seen over the last couple of days is US investors saying, how much will these Italian elections affect me? Let's tread quite carefully. And with the bond market coming off, that was a good situation. The economic data last couple of days, consumer confidence out the window. The Richmond Fed numbers very strong. Durable goods ex-transportation very strong last night, the highest in a year. Pending home sales strong, new home sales strong. All of those data points, again, another situation that the US economy is actually on the mend. We saw US 10-year yields up a modest 2 basis points. But I think the Italian election probably held the currency market back a little bit last night. It was only up until the last hour and a half that we saw euro dollar, euro yen, Aussie dollar, Kiwi dollar making a slight move up. Until that time, the equity markets were moving up, the bond market was moving, bond yields were moving down in the periphery, but the currency markets really didn't get a leg up at all until that last hour. So I think the asset class correlation trade has broken down. Again, very, very good for stock pickers. Stock pickers don't want to see a situation where a rising tide lifts all ships. And that correlation trade is breaking down a little bit, and that's very good for equities.
While we're talking equities, your expectations for the session today, the SPY suggesting a positive start, unsurprising after that European and US session.
Yeah, it's going to be a good day today, James. I mean, we saw a little bit of a pullback in our market. The market seems really nicely supported around 49.80, 49.75. You've got to keep your eye on that 21-day moving average now. We've been above it for by 64 sessions, 63 sessions, the longest time we've seen in years. So I think that's a really big positive. We've still got the uptrend in place from the November lows. So, we're seeing that until that breaks down, as soon as those levels actually break down, we're remaining pretty bullish on at least the index anyway. And we're expecting a very good day today. I mean, we've got the market opening at 50.80, so about a point. What was that? 0.9% gain. Materials have got a good lead in from the S&P materials sector, although commodity prices surprisingly haven't really done too much. The copper price is down modestly from where we went home yesterday. BHP's ADR is predicting a 0.8% gain, so it's a good number. And I think the yield plays very much in focus, as I say. Yeah, let's see what happens with those Capex numbers, because if they are really weak, that the chances then of a rate cut increases. That reinforces the dividend yield play, which has obviously been supporting our market. If they're strong, you know, it shows that businesses are confident in about their earnings cycle. So again, that could be construed in a very positive light as well. So, you know, it's going to be interesting to see how price action goes through today.
Yeah, absolutely. Look, Chris, great as always to talk. Thanks a lot.
Thanks, John.
Now, the powerful cyclone Rusty is unleashing its full fury on Western Australia's Pilbara.